following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. This is, of course, the program where we take you, the raw retail options recruit, and we break you down, sometimes quite dramatically, and then we rebuild you into seasoned options veterans. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the Options Insider Radio Network, upon which many of you are listening to this fine program right now. And of course, joining me as always here for my Options Bootcamp drill instructor squad, starting off with the man who is still weeping over the loss of the Charlie horse in his scenic and lovely Frankfort, Illinois. You know him, you love him. He is Dan Passarelli from Market Taker Mentoring. Dan, welcome back to the show, sir.
Oh, it is splendid to be here, my friend. Just splendid.
Are you wiping away a single tear right now for your beloved local restaurant?
Indeed.
That's probably the most press that place ever got, and probably that's why it's closed to this day. There we go, listeners around the world who are saying, what the heck is he talking about? Let's keep on rolling right on to our next cohort, our partner in crime. He is the options major domo over there at sogotrade.com, beaming in all the way from lovely and scenic New York City, New York, Mr. John Critchley. John, welcome back to the show to you as well.
Hi, Mark. Hi, Dan. Nice to be back today. We have a hot topic for the hot weather, kind of apropos, and we're looking forward to it.
Hot topic for some hot weather indeed. It's going to be a good one, listeners, so let's dive right into it with our basic training segment.
It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me?
Yes, sir.
You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me?
Yes, sir.
Call in. Prepare to learn.
Yes, sir.
All right, everybody, welcome to our basic training. This is, of course, the portion of the program where we take some basic options concept and then break it down into nice, easily digestible chunks for you, the retail listener. And today's an interesting topic. It's one that we've held off discussing on this show for quite a while because it is so difficult for so many retail traders to really wrap their heads around it. But it is also pivotal to true trading success. It is, in many ways, the final step that you could take down the process of really becoming a much more seasoned, much more experienced, much more professional type options trader. Now, we're talking today about that very, very frightening topic for a lot of retail customers, calendar spreads. If you're kind of new to the realm of spreads, then I encourage you to go back and listen to episode 13, which was our basic spreads episode, and then episode 14, which was our advanced spreads episode. Those were back in December and January, so you can go back and listen to those. And the reason we've held off for so long is because we wanted you to really get the full bedrock of knowledge that we've laid down here on this show over the past 20-odd episodes, to really show you things about Greeks and show you things about basic positions like collars and covered calls and protective puts and things like margin and expiration and basic spreads, and kind of working you up to this point, because this is, for many, like we said, like for many retail customers, this is truly a big leap for them when they start learning about calendar spreads. So let's start with that. What are we talking about here with calendar spreads? You know, the term has many different variations. Some people call them time spreads. Some people call them calendar spreads. There's variations within those, diagonals and horizontals. We'll get to those in a little bit. But quite frankly, time spreads, calendar spreads, we're all talking about the same thing. We're talking about spreads where, instead of the traditional spreads we've been talking about in the show for a while, which are mostly vertical, they're contained within the same expiration month. So let's say you buy an XYZ front month at the money call, and then you sell an XYZ front month a little bit out of the money call. That's your simple vertical spread. So called because it's straight up and down the option chain. These calendar spreads or time spreads go the other way. They're horizontal across they can be anyway. We'll get to that in a minute. But they spread out across the options chain to include multiple expiration months. And that's when people start to get a little wonky with these trades. They look at these and say, wow, multiple expiration months. I have things expiring at different times. That's kind of crazy. So when we're talking about calendar spreads or we're talking about time spreads, the usual nomenclature people use when they're talking about these, when they refer to buying or selling these spreads, is they usually key around the farther off month, because that month usually is more expensive. It's usually the crux, the focal point of the trade. So if you're buying a calendar spread, you're buying the far month, selling the near month, or vice versa. Show you a very basic example. Let's say XYZ right now. Let's say they have a July and an August expiration cycle, and you want to buy a very simple calendar spread. Let's say a call calendar. XYZ is trading at 50. Instead of just buying the July 50 call, you turn around and you buy a calendar spread. So you buy the August 50 call, and then you sell the July 50 call. And so there you have it. That is a very basic calendar spread. Now, listening to that example, you're probably scratching your head already saying, wow, there's a lot of weird stuff going on there. You have essentially two contrasting positions. You have a long call position in the farther off month, and you have a short call position in the near term month. You know, how does that work out? How do those two things come to pass? And understanding that balance, understanding that nuance, understanding how those two contrasting positions play off each other and work together is really where the difficulty comes in learning about calendar spreads. Now, Mr. Passarelli, I know when you're talking to a lot of your clients over there, I know eventually the talk, no matter what they come to you for, no matter what they're looking to do, I know the talk eventually turns to calendar spreads at some point in your discussion. So what are some of the talking points you mentioned? What are some of the warnings? What are some of the issues you bring up to your clients when they first approach you and the talk turns to the dark side of calendar spreads?
You know what? Calendars are way more complicated than people think. Calendar spreads are more complex than any other option strategy. And derivatives of calendars, of course, too, diagonals and doubles and blah, blah, blah. And a lot of people who have just taken a basic options class, they get taught by somebody who doesn't really understand calendar spreads well themselves, and they take an overly simplistic approach, and they end up losing money, and they can't figure out why they're not being successful. Or worse, what can be worse than that is maybe they don't always lose money, but without them knowing, they're not making as much as they should be making on their winners, and they're losing more than they should on their losers, and they don't even realize that they're doing poorly, because maybe they crank out a couple random winners here or there, and, they're struggling, and they think, oh, calendars, okay, they just work out okay. But really, if you really understand them inside and out, They can be fantastic, super powerful strategies, and they're great, and I love using them all the time.
The one thing I wanted just to bring up quickly, and this is slightly off topic, I guess, but I just want to pound home to all our retail customers. We're talking about spreads again. And I know I've mentioned this many, many times, but be careful using market orders. We had a customer the other day that put a market order in a spread, and he got a fill that was not what he expected. So be careful. There's no MBBO for spreads. You think you may get filled at a certain price, but you don't. So my advice always is put it mid-market, a little bit above or a little bit below if you're selling. And a lot of times you get filled. If you need to do the spread, take the ask, hit the bid, but be careful using a straight market order for spreads, with calendars especially.
Now let's dive into our discussion of calendars a little more and look at those two most common types. Now calendars do come in a variety of flavors. They come in all shapes and sizes. But the two most common are the ones I just referred to earlier, the typical horizontal and the diagonal calendar spread. Let's start off with the horizontal. That's the type of example I just laid out a moment ago, the XYZ 50-50 strike. Essentially, you're trading different expiration months but the same strike. So in that XYZ example, we had July and August buying a call and selling a call on the 50 strike in both months. So that's a very easy horizontal spread. You can see why it's called that, because you're simply jumping from one expiration month to the other. Straight line can be drawn between them. Simple horizontal spread. Diagonal, as you may guess, is a little bit more complicated in that you're doing different expiration months and different expiration strikes. So let's say in that same example, instead of buying the August 50 call, you now buy the Aug 60. So now you're buying the August 60 call and you're writing the July 50 call against it. Now you have a very simple diagonal spread on instead of a simple calendar spread. And that's really, when you start getting into those varieties, that's when people start getting confused. So I think we'll stick, for the initial part of our discussion anyway, with the very basic simple horizontal spread. Same strike, different months. People can wrap their heads around that. Usually a little bit easier. You start getting into the diagonals, it gets a little bit confusing. And the thing I would caution most people who are getting into calendars for the first time is they get thrown off by these two contrasting positions. But I would say really what you want to focus on is the spread, the differential between those two. When it helps, I think, for a lot of newcomers to, instead of focusing on these two contrasting positions, to think of the differential between the two, because that's really what you're trading. If you're buying the spread, i.e. if you're buying the long-term month, selling the nearer-term month, you want that spread, typically in most scenarios, you want it to expand. So if you're paying 15 cents for it, that's a differential between those two options. You want that differential to expand. You want that spread to expand and become 30 or 50 cents or $1 or $2. That's what you want to happen with those types of trades. And typically the inverse is true when you're looking at selling a spread. You want that spread to contract. You want the difference between those two option prices to get smaller and hopefully eventually become zero, and maybe even cut the credit your way. Who knows? So that's the typical rationale people have when they're getting into these spreads. Of course, there's a lot of balancing acts that go along with that. Now, Dan, I think the first stumbling block a lot of people come to when they're looking at a simple horizontal calendar spread is that contrasting position, like the one I just laid out. Buying the Aug 50 call, selling the July 50 call. Wait a minute, those are two polar opposite things. If I'm selling the July 50 call, I want the stock to drop. If I'm buying the Aug 50 call, I want the stock to rally. So how do you walk your students through being able to wrap their heads around those two very different and in many senses diametrically opposed positions in the same spread?
A lot of people talk about volatility being an asset class. And I think a lot of people who are stock investors who don't know too much about options, you kind of hear this and your eyes glaze over and you go and do something else because it just makes your head hurt. But when you trade spreads, you are trading something different than direction. You're trading the optionality. You're trading other option characteristics besides direction. And specifically, you're really doing two things. One of the things you're doing is you're trading volatility. And one of the other things you're doing with the calendar spread is you're doing something kind of smart, kind of clever. You're exploiting your knowledge of options. you're taking advantage of something that the casual observer probably doesn't really even realize. And what that is the time decay differential. I don't know, maybe I'm jumping a little ahead of where you wanted to go here, Mark, but
go with it, sir. Run.
Sure. When you buy an option that has a lot of time until expiration, the time decay is very small. Time decay is measured by theta. The amount that option decays is very, very small. But then in a time spread, in addition to buying a longer term option, you're selling a shorter term option, and shorter term options have a higher rate of time decay, a higher theta. And so they lose their value very quickly. So the option that you're long loses value but doesn't lose a lot of value. The option you're short loses value very quickly. So you're kind of exploiting this little nuance of how time decay works. And the best way you can take advantage of that nuance is with a time spread and putting on the spread like this. So forget about direction. Forget about calls bullish, and if I short them, they're bearish. You're doing something different. You're doing something smarter. You're trading options, not trading stocks using options as a proxy. You're trading the characteristics that cause options to make or lose money, like time decay and volatility. So, I mean, the best way to really wrap your head around it is to, heed my warning that calendar spreads can be a lot more complex than typical positions, and make sure you understand all the nuances of option prices in general, and you'll be surprised what power you can unleash. And one of the great ways of doing that is using time spreads.
If there's one goal I think we have for our listeners for this program here is to take that retail options trader who's so typically focused on delta. We said in our early episodes, what's the difference between retail and institutional? Retail focuses on direction / delta. Institutional focuses on volatility / vega. And we're trying to get the retail to kind of move a little bit closer to that realm as well. And that's where calendar spreads really come in. Like you said, Dan, this is really getting retail to kind of move a little bit away from that delta crutch, that directional crutch. I want the stock to go up, I buy a call. I want the stock to go down, I buy a put. And really starting to think more about the nuances, the interplays of the options themselves. And one of those interplays, one of those delicate balances that really tends to throw some people off when they first get to time spreads, not only the fact that they have those contrasting positions, so you have, like in that example we just said before with the calls, which get people thrown off to begin with, but also, like you said, Dan, the Greeks are a little bit different. You mentioned time decay. Of course, when you think about volatility, remember, listeners, when we talked about the Greeks in our early episodes, volatility is a function that increases as you go farther out in time. So when you're looking at the farther off month, by definition, that's going to have a larger volatility component, more vega, more volatility in it, more juice, if you like to use the slang term there, more premium built into it than the near-term contract, unless you're doing some crazy diagonal where things are all kinds of wonky or a ratio or something. But in a typical straightforward horizontal time spread, the longer-term contract's going to have more volatility in it. It's going to have more volatility in it. It's going to be more expensive as a result. So if whatever you're doing to that longer-term contract is what you're doing to volatility in your spread. If you're buying that long-term contract, you're buying vol. You're long vol now. So think about it. If you're long volatility, you typically want a lot of movement. You want a lot of action. You want a lot of juice to build into that contract so the volatility increases so your profits go up. Typically what generates the most volatility is an aggressive downside move. But now the other side of that spread, what you've just done, is you've turned around also and sold, let's say, the front month contract, which, as we've discussed on our earlier episodes, is very heavy, not only with time decay, but time decay and its buddy gamma go hand in hand. High time decay equals high theta. High time decay equals high gamma. They correlate to each other. So a very near-term contract is going to have a very high gamma, which essentially translates to that delta's changing quite a bit as the underlying moves. So swings in the underlying are going to dramatically impact that type of spread. So you have this traditional balance going on in time spreads where, let's say you're long that horizontal spread, you're long vol. So in a typical long vol position, you want an aggressive crash to boost that vol and really juice up your position. But at the same time, you're short the gamma gamma in the front month, and you know that an aggressive downside move or an aggressive move in any direction could really come back to bite you in a very, very difficult and costly fashion. So Dan, gamma, you wrote the book on the Greeks, gamma versus vega. That's really the battle we come down to in time spreads. Where do you come down on that battle?
Yeah, this once again further illustrates just the uniqueness of time spreads. Typically, what traders are used to seeing in their option positions is if I have positive vega, I have positive gamma. If I have negative vega, I have negative gamma. But time spreads is the one spread where you don't see that. Where if the vega is positive, the gamma is negative, or vice versa. And so you have opposite positions in realized and implied volatility, basically. And that's still an oversimplified statement. Because you have negative gamma, you're effectively short realized volatility. You don't want the underlying stock to move much. Because you're long vega, the oversimplified statement, which I'm going to basically go back on in a second, is that you want implied volatility to increase. Again, I'm going to caveat that by saying I just lied to you. But yeah, so you really got to watch these things, and you have to appreciate that difference in the different types of volatility and how they affect your spread.
So a lot of people out there might be thinking, why would I use these calendar spreads? What's a scenario in which I might want to do this? I might want to buy a longer-term call or longer-term option and then sell a shorter-term option and create these contrasting positions. And earnings are a very good example of a time when you may want to take advantage of these types of spreads. So a lot of people recently, as we're recording this, Ford was trading around $17. A lot of people were talking about very near-term weekly Ford call spreads, just simple horizontal 1-week call spreads on the 17 strike. That's going to be a very popular trade going up. So there's a lot of different examples that people can use. I know, John, people call you up over there at Sogo all the time, probably asking you to walk them through examples like this. If someone calls you up and says, hey, I'm looking at trading some spreads going into earnings, what's your typical example for them? Walk us through your typical basic horizontal call spread, or I'm sorry, your basic horizontal calendar spread example, maybe around earnings season, a trade you like to do, a trade you've done in the past, maybe an example you like to give to your clients over there at Sogo Trade.
Sure. As you said, we're in the heart of earnings season, so it's a very salient topic right now. The typical behavior is obviously around earnings is the rise in volatility in anticipation of the earnings event. But customers must realize that after the event, there's going to be a quick drop in that implied volatility. The news is out, and now the options are going to mean revert back to a more the typical implied volatility. So, with the advent of weekly options, customers always have the very short-term series of trade. So what a customer can do is, what I tell a customer to do, and what I do is that I usually go out about 4 or 5 quarters. I look at the movement in the underlying after the earnings, and then with the very short-term series that we have, that will, if you look at the at-the-money straddle, that will give you the predicted move in the underlying. For example, Google. If you went back 5 quarters, I think the average move was about 5%. Okay. If you look at the straddle going into earnings, this was in April, it was implying about a 6% move. Oh, so there's a difference there. So what do you do there? So in the case like that, if you think that the front month volatility or the front month premium is too high, what you can do is you can sell the front month at the money straddle or the front month, and you buy, let's say it's by September, you buy the back month. So you buy the calendar. And what you're hoping is that there's a move, but not that great a move. And that all that juice in the front month, all the at the money straddle gets sucked out. And what you own now is you own the September options. Now be careful. One thing, folks, the September options are going to decrease in value, and it's a question of how much. So that's a really very kind of tricky thing. And on our system, we have the option calculator. And I think Google right now, I think the September options are about 22 volatility, and you have to price in, let's say, going to maybe 17 or 18 or 19 and figure out where the options may go. So if you put that trade on, you're looking for Google not to move that much. And why is that? Right now, for example, the Google SEP 900 July front month 900 put spread is trading for about $14. Okay, so if you put that on today, and then Google has terrible earnings, and the stock goes to 800, well, I go to my option calculator in our system, and I put in 18 volatility, and I put all the different numbers in, and guess what? The July options are now parity; they're $100, and the September's that I own are about $103. So guess what? That $17 spread is now $3. So there's a very clear example of going into an event that if you buy the calendar, you don't really want it moving that much because all the extrinsic value is going to be sucked out, and you're going to be a loser.
Yesterday, John Kamisic, who teaches our Market Taker Live Advantage Group coaching class, had one of his rare days off. The guy works like a maniac. When John, because this class is every day, when John takes the day off, this guy, me, I'm pointing at myself right now, listeners, fills in. And so I was teaching the group coaching class yesterday, and we talk about trade ideas in that class. One of the trade ideas that I talked about was it was one of the stocks that has earnings coming up on it. And a guy said, hey, I'm thinking about playing this stock going into earnings. I'm bullish. I think the report's going to, come out and the stock's going to rally. I'm thinking about buying a call in there. And I said, well, look at the volatility of these calls, especially the front month volatility, because those are the ones that have the high gamma. Those are the ones that can go, from being worth a teeny bit to being worth a ton. You get a huge leverage profit. They were so overpriced in terms of volatility that even if the stock did rise, when volatility collapses after earnings, the guy was probably going to lose money even if he's right. So how I discussed trading this is by using a time spread. 9 times out of 10, if you are doing a directional earnings trade, you have to trade it by using a directional time spread, because any other way is not going to yield the results that you're looking for. I don't play a lot of earnings, but when I do, I almost always use time spreads, because the implied volatility of those front month options that you'd be selling, or what I really like to do is use the weekly options, can be so high that those options get so expensive that I can buy a 2-month option and sell a weekly option for more than 50% of what the 2-month option is. And because you have that, because those short-term options get so expensive going into earnings, and those are the ones you're selling, you want them to be expensive, a lot of times you can be wrong and still make money or still break even. You can have a huge leverage profit if you're right and the stock ends up going where you think it's going to go on earnings. If it overshoots your target, you probably still end up making money. If the stock doesn't move a lot of times, you can break even or still make money. Or if the stock goes the wrong direction, a lot of times you can still break even or maybe even make money. So they're super forgiving. They're super advantageous a lot of the times because of the volatility differential. And they're just a super strategic strategy that's perfect for playing earnings.
I like strategic strategies. Those are my favorite types of strategies.
I can't believe I said strategic strategies.
That's good. That's like a Bushism. That's pretty good. I want to keep that. Maybe we'll call this show strategic strategies going. I can't even say it. Strategic strategies going forward. That's good stuff. But you're talking about the educational component, Dan. Obviously, that's what a lot of what you do. That's what our focus is here on this show today. And the typical approach to options education has always been a very rigid one that I've always railed against. I know you and John probably have as well. Very standard. Here's your P&L diagram. Here's you buy a call. Here's how it can look at expiration. Here's how it looks at the stocks here. And there is some value to that to let people see the extremes and kind of see how that can turn out. But that's really the main approach to options education these days. And the problem with that really is that when you're looking at P&L diagrams, they kind of get a little bit difficult to use those effectively to educate people when it comes to calendar spreads, because that's just a difficult prospect. So first off, talk about the difficulties of using these P&L diagrams with calendar spreads, Dan, and then tell our listeners kind of what you use in lieu of them when you're instructing your mentees over there.
Yeah, profit and loss diagrams, they give you the break even, the maximum profit, and the maximum loss, and only one of those actually works with calendar spreads, the maximum loss. So you can't use the profit and loss diagrams. Instead, what you have to use is your knowledge of the Greeks. And especially considering profit and loss diagrams are really only valid at expiration. They are a snapshot of the profit or loss at one particular point in time. And, especially if you're playing earnings, you're going to take it off long before expiration. And I encourage people to close all their trades before expiration anyway. So you need to use your knowledge of the Greeks. You need to monitor your delta and how that changes via your gamma. You need to monitor your theta, which when you're buying time spread should always be positive. And then when it comes to volatility, it starts getting a little bit trickier. You can't just look at the straight Vega. Mark, is it time to jump into our volatility discussion here?
Sure, go ahead.
Okay. So here's the really tricky part when it comes to time spreads, why I say they're the most complex option strategy. When you look at the Vega of a time spread, a long time spread, it's positive, which leads one to believe that if volatility increases, you make money, and if volatility decreases, you lose money. However, that's not always the case, because you're trading two options, you're buying one and selling the other, but each of them can have their own unique implied volatility attached to it. So I'm buying volatility in 1 month, and I might make or lose money on that Vega of that one leg of the spread, but then I'm selling volatility in the front month, which has its unique Vega, which is negative, and I might make or lose money on that option. The goal is to make money on both, or at least one, and not lose on the other. So here's the little secret that is not a secret to anybody who's been a professional trader, but it's a secret to a lot of non-professionals for sure, that I teach my students in trading time spreads, is that what you need to do is you need to buy cheap volatility in the back month and sell expensive volatility in the front month. So there's a number of techniques to doing that successfully, but the simplest and most basic one is make sure that the option you're selling has a higher implied volatility than the option you're buying, that there is a volatility differential and you're selling the high one and buying the low one. Now, that's just the start of the story. There's more to it than that, of course. But you keep that in mind every time you trade a time spread, you're going to see different results. You're going to start seeing that you're making more on your winners, losing less on your losers, and you're going to be having more frequent winners because you're getting an actual edge on your trades.
Can I just mention one thing about the graphs? And Dan and Mark really hit a great point. And the standard graphs are tricky to use for the customers for these calendars. But I know in our systems, I helped develop with the SocoTrade system, we can you're able to put in different times, timetables. Like you can adjust the time, you can move forward in time, and you also can change the volatility. So what I do is, if I'm going to put a calendar spread on, I'll put the trade on for the prices that I put it on, and then I'll move the underlying down 30 points. I'll drop volatility 10 points, or whatever whatever parameter I want to use. But if you have a system like SocoTrade where you can change the date and the implied volatility, then and you become familiar with it. It's kind of tricky. You have to learn it. It takes time to educate yourself. And if you call me, I can help walk people through it. But you can be able to use graphs to give you some gauge to to where you're looking. For example, like when I used to trade Apple, every time after earnings, volatility would go from the back months to maybe was 45, and it would drop to about 30. So the traders knew that. So if you had a system, you could plug those numbers in and say, well, if I buy the calendar, and what's going to happen if Apple goes 20 points, 30 points, 10 points. So just be aware that there are tools out there that can help you a little bit. But Dan and Mark are right. The basic cookie cutter P&L graphs don't work that well.
Yeah, and hopefully whichever platform you use to execute your options trades, you can find some tool there to really help you do exactly what John was just saying, which is move the underlying needle a little bit, move the Greeks around a little bit, and see how that impacts your positions. That's really one of the best ways to learn how these positions actually perform in the real world, is to see these various scenarios. I know when John and Dan and myself were all market makers on the floor, we would have runs every night to see, here's how our position looks, up 5%, up down percent, here's how it looks if volatility spikes 20% or decreases. And these are the types of things you have to look at to get a true sense of risk management. And when you're doing these types of calendars in particular, you really need to start playing with that a little bit more, because you said we're kind of jumping to the next level here now. We're not just talking about simple direction. We're talking about the interplay of options. And in order to really understand that, you really have to see that. That's why paper trading is a good way to do that if you don't want to risk your own capital. But once you start getting, hopefully you listen to this show long enough, you're putting some of your own skin in the game now. You're starting to actually trade these products for yourself and see how they work, see how these trades unfold in the marketplace. And you're ready for some very basic calendars.
Mark, can I mention one more thing real quick?
Good.
Just as a trader, retail trader, be careful, because if there's an event happening on earnings or an FDA announcement, most normally, and Mark had hit on this before, normally the front month volatility is going to be lower than the back month volatility. And if you want to keep selling, if you want to keep buying calendars, buy calendars, sell the front month, you're doing it for a discount. So be careful. And the traders know that, and it's a premium selling strategy to sell the front month and collect all this wonderful decay and all this premium. But a lot of times the front month options, they don't have much juice in them. So unless there's an event, be careful. And Mark's right, and Dan's right. Look at the implied volatilities, and if you see the implied volatilities of the front month going higher than the back month, that might be an opportune time. But in general, that's not the case.
So, there are a number of different times you may want to employ strategies like this under a variety of different scenarios. And, we talked earlier in my very simple example, the July AUG 50 horizontal call spread there, and everyone's favorite name, XYZ. And that's a simple name. You're looking at buying 1 month out, you're selling the front month, so now you're long a little bit of vol, you're short a little bit of gamma. And that type of scenario would actually, because you're short that gamma on that front month strike, you would like the underlying to typically hover around in that range around that front month 50 strike, because think about that spread. You have that longer term option, you have that front month option. There's a very wide decay differential between those two. That front month option is decaying much faster than that second month option. So if you can hover around that strike where that decay is highest and the option will decay the fastest, that differential will increase and that spread will work out for you in much better fashion than it would if there was a dramatic, let's say, drop down 30 handles or something along those lines. Of course, that would be pretty dramatic in any regard. But, that's just one quick example. Dan, when people come to you and say, what should I do with these calendar spread things? When should I use them? What are some scenarios? Let's take that same example. Let's take that typical, simple 1 month out horizontal call calendar and walk our listeners through a couple of other examples of when they may want to use that, and perhaps more importantly, when they may want to avoid using that scenario.
The typical use of a straight calendar spread is for income generation, and it's generally a neutral strategy. I mean, I mentioned before you can use them directionally, but typically they're used as neutral strategies. So the setup conceptually is very, very easy. There's a simple series of steps that a trader needs to take to set up a good time spread that has edge. First, look for a neutral stock that's trading in a channel. It hits support, bounces higher. Then it hits resistance, bounces lower. It's in that straight horizontal channel. That's step one. That's the directional one. That's what helps guard you against your negative gamma risk. You need it to be going sideways and not trending higher or lower. Next thing is you want to look to see if there is a volatility differential. Remember, you need to sell the higher volatility, buy the lower volatility. Can you do that? If you can't, don't trade it. That is, it's like think of it as a checklist. Okay, are we in a channel? Yes, check. Okay, so far we got an okay candidate. We got to go through the rest of our checklist. Step 2, is there a volatility differential? Am I going to be selling a higher volatility than I'm buying? If yes, okay, now I can go to the option chain and construct a spread. If no, then no, I can't. I've got to move on and look at a different underlying. And that's it. I mean, I guess that's maybe a little bit oversimplified. I mean, when I'm working one-on-one with my students, I mean, we dig a little deeper, but I mean, that's it. It's basically a 2-step checklist. Simple.
And I just want to hit on something else you touched on before, Dan, earlier, because I see this a lot with people coming to the site and coming to the network for the first time and learning about these different types of spreads. And I know how they think when they look at these simple calendar spreads. Like in this call calendar we were just outlining here in XYZ. They're thinking of it because they've been trained this way. It's not really their fault. They've been trained with these expiration graphs to always think, to expiration. That's how their mind always leaps. How does this work at expiration? So they probably think of how, and that gets into the management of these types of spreads and how difficult it can be for some of these people who think that way, because they're looking at these spreads and thinking, if I hold this by this XYZ July, August 50 call spread here, and then the stock stays at 50 the whole time, these 50 calls go out worthless in July, then I have a free or really cheap 50 call spread, or 50 call position, here in August, and I want the stock to rally after that. And they think of it in this very strange, almost bifurcated way. They think of what happens when one leg goes to expiration, and then what one other leg that I have left over, what will happen to that. So they think of it almost as a 2-step process. What's going to happen to maximize the front leg, and then what's going to happen to really maximize the back leg. And that's really not the ideal approach. That really kind of goes the opposite of what we were saying at the top of the show, is you really want to think of these things in terms of spreads. You want to think of them in terms of the differential, how they play off one option versus the other. So in that type of scenario, you really want to maximize the spread differential. And you probably, when you're trading these, you shouldn't think of them as this kind of bifurcated, one leg expires, then the other one goes out, or maybe I close it off here and leave this leg open. You really think of it as a spread, as a single entity. So you open it that way, and then you close it that way, because that's kind of the way most professionals do it, and that's the way to really maximize that. Now, you could always do things like take off a little bit of a ratio here or there if something's really going your way on one leg of the spread. But in general, it always kind of drives me crazy when I see people coming in and looking at them as these kind of bifurcated instruments of these, even something as simple as a simple 2-legged horizontal call calendar here, and waiting for one part to expire, then they have this other position they have to manage. And really, like we said many times on the show, the management of all options positions is key, and nowhere is that more important than when you're talking about calendar spreads here, because that's really where the rubber meets the road. And if you manage them ineffectively, if you look at them as this bifurcated process rather than a complete single unit, a single entity spread, that's where things can really get a little bit difficult. Is that how you walk your students through it usually as well, Dan?
Yep, absolutely. Well, let me kind of add to that. What I've advocated on a number of occasions to students is kind of taking a very broad approach where you look at a spread, and any given spreads. I mean, right now we're talking in the context of time spreads. But you look at it exactly what you're saying as one single unit. Like this time spread consisting of 2 options is one single trade. But then I also like them to look at it, as I refer to it as on legs, look at the individual options as well. You're going to have to kind of train your mind to not really care too much about the direction, because they're offsetting each other, but analyze the one, especially in terms of volatility. Is this volatility higher than it should be, and is this volatility lower than it should be? And I just think when you look at a spread, especially the complex spreads like maybe double calendars or double diagonals, if you look at those as one single trade unit and then break it down to, it's actually 2 time spreads, so I can look at it also as 2 time spreads, and it's also 4 different options, so I can kind of consider it as 4 different options as well. And then you kind of wrap that all into one package in your brain. now you're really going to understand the spread because you looked at it. It's like, when you go out to buy a car, you don't just kind of, look at the driver's side and say, oh, it's a fine car, I'll take it. You kind of walk around it and look at it from different angles, look at it on the inside, look under the hood, check it out, and approach it from many different angles. So that's what I like to do with my spreads.
And as always, there are other components to consider when you're trading spreads, and we've touched on it quite a bit in some recent episodes, the margin implications of spreads and how that impacts what you can and can't do in your trading account. And that's something that pretty much no one ever really touches on when they're talking about options and options education. So we like to make sure to hit on it here on the old Options Bootcamp program. And as it just so happens, John and the folks over at Sogo really just went through a massive margin overhaul and added some really cool margin tools. So thankfully, John is up to speed on the latest minutia of margin, listeners, and he can really give you the latest up-to-date information on how this stuff impacts your trading. Now, John, we're talking here about simple horizontal calendar spreads, simple horizontal time spreads. Walk our listeners through some of the things they should be aware of from a margin perspective when they're thinking about jumping into the time spread arena.
Sure, this is a really important topic. Now, I think we've been focusing a lot on, long calendars. And of course, when you buy a long calendar, you pay a debit, and that's going to be your margin requirement. But we get a lot of questions. I get a lot of questions when a customer says, well, I want to sell the back month and I want to buy the front month, and it's an earnings play or something. And I only have a certain level of approval, and I don't really have much money in my account. Why can't I do it? Well, the simple answer is that because when you try to do a trade like that, the margin system is going to pick up that because the option that you're long expires before the short option, then we're going to margin that, and most programs do. And once they have portfolio margining, they're going to margin that as you're this naked short that the one part of the spread. So you may think, well, I'm covered. I have a calendar on, and as a trader, that's how I traded and how you guys traded. But for the retail customer, when they want to short a calendar, the margin is going to focus on, well, we don't know what you're going to do between now and expiration, and we can't have you, or you need to have enough margin to cover that short option. So that's one thing that customers get very confused by, and we try to walk them through that you need to have a level 4, level 5, naked or uncovered writing privileges to be able to do those kind of trades.
That's a good point, and it's something that I don't think a lot of people consider when they're coming to these for the first time. They look at the P&L graphs, they study the Greeks, they try to figure out how these trades perform in different scenarios, and they listen to shows like this, and they get a little bit more fluent in how these trades actually work and what they are, but they don't think about that margin component. And I think, like you said, John, a lot of people would intuitively think if they were shorting the time spread, and remember, when you're talking about buying and selling calendar spreads or time spreads, same thing, you key off the far month. That's usually how the nomenclature works. So when you're selling it, you're selling the longer term month and you're buying the closer, nearer term month. So people would think when they're doing that, let's say they flip my example around, and instead of buying the AUG 50 call in XYZ and selling the July 50 call, they sell the AUG 50 and they buy the July 50. They would think, well, naturally, I'm covered. I have this July position. And they would probably assume that at least for the July portion of that spread through that expiration, they would be treated as covered. But you're telling them that is not the case. They're essentially being treated as if they're just naked shorting those AUG 50s. That's what you're saying, John?
Yeah, that's what I'm saying. And that's actually, when I first came here a few years ago, as a trader, I had maybe that same type of attitude. And we were going through all the margin and all different calculations. And I did a lot of studying on different platforms, different brokers. And my reaction was similar to what you just said. Well, I'm covered. Why are you treating this as a naked position? It's because the brokers can't. It's very hard for them to navigate or to navigate it right up until expiration and then make sure you're covered. Say they can't force you to, on expiration Friday in July, well, now, you have to cover that August. And if you don't, then you're going to be naked. And so that's a reason why. And a lot of customers, do get confused by that.
And rightfully so. It's a confusing thing. And that's something I think a lot of people really need to take into consideration. There is an opportunity cost. Unless you have a very sizable account, like John said, unless you qualify for portfolio margining, which is typically over $100,000 in your brokerage account that you're trading options in, and you have all of the permissions, level 5 and what have you, they're really going to charge you an arm and a leg to do the margin on this. So keep that in mind. There is an opportunity cost to coming out and shorting these calendar spreads, which for a lot of you, a lot of our listeners, I probably would recommend they start with the long side anyway. I think that's more intuitive to a lot of people, and they could work around that. But like Dan said earlier, it's a much more directionally neutral type trade, and if you have a range-bound type name, a long, simple horizontal calendar spread is a perfect trade for that. So just to kind of wrap up here what we went through, we kind of ran through all this. There's a lot to get to, so much to get to really with calendar spreads. Like we said, this really is the next level for the retail options trader, being able to wrap their minds around two separate expiration months at the exact same time. It's very difficult, but let's run down it again for you to give a little bit more of an overview. So we're talking about calendar spreads, time spreads. Those are essentially the same thing. They come in two basic varieties. You have the simple horizontal, which is the different months, same strike. So that's your June, July, or July, August example, like we were just saying. 50 call spread or 50 put spread, same strike, different expiration months. You also have diagonals. You have a different month and a different strike. It's a little bit more confusing. Let's say you're doing July, Aug, and XYZ again. Now you're talking July 50, Aug 60. So you have that diagonal as opposed to the simple horizontal. We're focusing on the horizontals here today because they're a little bit easier to wrap your head around. And there's a lot to keep in mind when you're looking at calendar spreads. You want to maximize, again, think of it as a unit, and you want to maximize the differential between these two options. So we talked earlier in this show many times and in episodes previous of this program about time decay, how nearer term options decay faster than longer term options. Keep that in mind when you're trading these spreads because you're looking to maximize that differential. You want to buy an option that is not going to decay as fast as the option that you're selling, which is in the nearer term month when you're buying these simple horizontal calendars. As Dan said earlier, you also have to look to maximize the volatility differentials. So you want to find a strike that has been bid up from a volatility perspective and sell that, and then buy a strike that has been comparatively undersold, or I should say, a strike that has been comparatively oversold from an implied volatility perspective, and be able to capture that differential as well. So when volatility comes back to the norm, you collect that, as well as when the decay differential kicks in, you can really collect that expansion, that explosion in the spread. Remember, you're buying it, so you want that differential to increase. So these are some things you want to watch out for when you're looking at calendar spreads. There's so much more to get to, really. Maybe we can devote another episode to this down the road because there is so much more to get to. We didn't even really have time to get to your listener mail, so we'll get to that next episode, listeners. So if you wrote in, pay attention to that for an upcoming episode. But maybe we'll wrap up here, and Dan, you can give our listeners your last thoughts here, kind of your synopsis on calendar spreads, or at least calendar spreads part one. I have a feeling we're going to be revisiting this topic down the road. Calendar spreads
are volatility trades. You understand that, and you understand the hearts of calendar spreads. That's it in a nutshell right there. Let's keep it simple.
And also remember your strategic strategery, or what was it you said? Sorry, still can't say it, but it's good.
Strategery and strategic strategies.
There we go. Calendars are strategic strategies you may want to employ for your options trading benefit. And Mr. Critchley, what are some last thoughts you want to leave our listeners with regarding time spreads?
Well, the one thing I want to mention is, as traders on the floor, traders on the floor, they're volatility traders. And, calendars are one great way for, for the retail customer to, not trade like a trader, and so to speak, but if you put on these calendars, you're making a volatility bet, and maybe you're making a directional bet, maybe you're making a theta bet, or a decay bet, but they're excellent strategies to employ, and read about them, use the graphs, and understand them, and they can be an incredible part of your trading, the way you trade. And also in the future episode, we're going to go into how we can, more different types of calendar spreads and stock replacement and all this other kind of stuff. So there's much more to go, folks, down the road. And we'll be hitting on it pretty soon, I'm sure. Yeah, so listeners, the next time you're setting up a trade and you're looking at a name, maybe going into earnings and saying, wow, this is going to go up, maybe I'm going to buy a call here, start doing a little bit extra homework and start saying, maybe, what if I looked at a simple horizontal calendar spread here? How would that really work for me? Start weighing through the pros and cons in your mind. Remember those differentials we talked about. Look at the theta differential. Pick a month and strike that works out for you to capture that theta differential. Look at those volatility differentials and start to capture
capture those as well and start thinking about how that trade would perform at different levels in the underlying. You can use your software to help you do that if you want to, or you can just start thinking about it in your head. It's a good thought exercise to work through as well, to really start to understand how these things perform, is to work through what happens if this happens, what happens if this happens, and start to see, maybe you think about it in your head first and then you run it in your software on your brokerage platform to say, oh, I was right or I was wrong. This actually worked out terribly for me, or vice versa. So there's a lot of different steps you should take, but we want to encourage you, if you're listening to this program, to start thinking about adding calendar spreads into your trading mix, into your trading arsenal. I know it's intimidating. I know it's frightening, but when you start thinking about them, you can do them little baby steps at a time, a little bit, and next thing you know, you're doing a simple call calendar here, and next thing you know, you're doing a simple put horizontal here, and you start to realize, wait a minute, those differentials are kind of meaningless. Call, put, spread, really kind of not the same, really kind of the same thing, and you start to get back into what we learned about synthetics earlier, and it all starts to come together, and next thing you know, you're trading crazy ratio diagonal time spreads and all kinds of fun stuff, because you've really mastered the fundamental mechanics that underpin everything we're talking about here today. But unfortunately, that's all the time we have for this episode on calendar spreads. But like I said, I think we're going to come back to this topic again because it is just so meaty. There's so much to talk about. The more examples to talk about. We haven't even really gotten into diagonals much at all, so we can get into those and how they differ a bit from your typical horizontal calendar spreads, and so much more to come. But before we go, as always, I like to check in with my cohorts, my partners in crime over here on the Options Bootcamp program, to see what they have cooking in their respective necks of the woods that may interest you, our Options Bootcamp listener. We'll start with you, Dan. What is cooking over there in the realm of market taker mentoring? I have a feeling I know what you're going to say, but go ahead, lay it on us anyway.
I bet you do. It is our futures options class. We've been at it for, maybe a month or so. And the futures options class is really exciting. It's an everyday class where you get trade ideas and education on specifically futures options. And, for those of you guys who don't trade futures options yet, I'm not talking about just the boring stuff, corn and soybeans and all that business and orange juice. But I'm talking about stuff that's relevant even if you're not in the realm of the commodities. I'm talking about E-minis and that kind of thing, futures options on the S&P 500, energies, treasuries, currencies, stuff that you're probably already watching anyway. And here you're getting a professional's opinions on these every single day. And we've got a special deal going on right now. The class is less than half price right now. So email me, dan@markettaker.com, and I can explain to you what to look for. Or you can just visit our page, markettaker.com/FO, as in futures options.
And if you'd like a sneak peek of what you may learn in that class, we had Dan's instructor for that class, Dave Rogers, on the premiere episode of our newest addition to the Options Insider Radio Network. It is indeed a futures options program coming very soon to this fine network, so stay tuned for that. We're in the final process of dotting the I's and crossing the old T's and getting everything put together in post-production so we can get that episode out to you very shortly. So stay tuned to wherever you find our programs, iTunes, Stitcher, AHA Mobile, or theoptionsinsider.com, or wherever you find our stuff, because that show is coming your way very shortly. And last, but certainly not least, Mr. Critchley, a.k.a. the Major Domo over there at Sogo. What is cooking? Are you guys finally ready to unleash your brand new margin tools on the masses?
Yes, we have. We did a soft launch, and so we're just kind of doing a little internal beta testing, on a limited production site. But I wanted just to let customers know and listeners know, as we talk about these strategies, we have a dedicated strategy section on our platform, and we have about 25 different strategies. And I know I mentioned this in the past, but in this section, it's a quick view. You can go in there and it gives you the market view to put a certain trade on, the level of proficiency that you need as a trader for the trade, the tactic, the risk reward, the P&L. So as we talk about calendars and horizontals and diagonals, they're all in there. And as we get more robust in our multi-leg capability, we're going to be adding more and more and more. So it's a kind of all-in-one shopping place. You're on the platform, and you go right to the strategy section, and then you can launch a trade right from there. So it's a pretty cool tool.
All right, thank you for that, John. If you want to learn more about that, of course, surf on over to sogotrade.com. You can check out those tools, all the other great tools, the other education they have available up there from John and the other options guys over there at SogoTrade. And, of course, you can even check out episodes of this program. So if you missed one, you can check them out over there at sogotrade.com or, of course, surf on over to theoptionsinsider.com. We have all of the archives of this program. And if you're a little confused about anything we talked about on today's episode of calendar spreads, and I'm assuming you probably are because, like we said, calendar spreads are indeed that next level for a lot of retail options traders. Go back, review this show. Maybe you go back and review our episode 13 and 14 basic and advanced spreads. Give you a little bit better idea of how those spreads work and how they play off each other. And, of course, we have much more to come on this program on this very topic of calendar spreads. So stay tuned for that, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.